And you want to move in there. You want to move in. You want to point. You want to point and walk us through it. There you go.
Okay,
Perfect. And speak loud.
Internal rate of return. So I took the cash flows and then times it by, I don't know, the 1.12, and then did it for 6 years. And that's how I got the 680.794. Thank you.
Alright, so mine was on using EBITDA and co-EBITDA. So there's a Love Cities produces modern light fixtures that sell for $150 per unit, and their variable cost is $55 per unit, which comes out to a high capacity of $95 per unit. And then if the machine was not purchased, the annual cost would be. So then I also did the fixed cost and the depreciation and amortization, which came out to 90. And then the no high capacity came out to 35,000, which was the fixed cost minus or plus the depreciation and amortizations. And then for the no high capacity, the units was $150 minus the variable cost of $105. And so I just set the equation up, which came out to be fixed costs plus the depreciation and amortization minus the no high capacity fixed cost and plus the depreciation and amortization over the high capacity sum, and then the no capacity minus the no capacity sum, which came out to 1,100 units.
So mine is Spring Lake Manufacturing needs to purchase a new central air conditioning system for a plant. The first system costs $50,000 and it's expected to last 10 years, so that's why it's to the 10th power. The second system costs $72,000 and is expected to last 15 years. And the opportunity cost of capital is 10%, so that's why it's 0.1 and 1.1 on those. And Spring Lane should purchase the first one. It's cheaper.
Because it's the lowest cost.
Yeah.
Got it. Thank you. Perfect. I got it. Thanks. I'm getting good at it.
Alright, so I had cost of common stock, 13, I'm going to start here because I had to write the second one over there. But you use the constant growth formula, you plug in your variables, so you got your annual paid dividends, your percentage of expected increase on the annual dividend, and your current price of your common share of the business. And in this example, the business is called White Wall. So after you plug in your variables, you just do the arithmetic all the way down until you get to your percentage of increase from your expected current price of the common share. So 60% growth from $11.66. And then the second problem, cost of common stock, same kind of problem except a little bit shorter. You just get your dividends payable. So you put into the formula, which is just $1 over 10 and over 13.75, which is 0.08, and then plus your expected dividend increase, which is 0.05, which gives you 13% increase.
So it's your dividend yield plus the growth rate. And that's what's the other way of calculating the cost of common stock? What would be another model we could use? Test question. What could be another model that we could use to determine the cost of the equity? We went over it on Tuesday. What's another method that we could use to determine the cost of the equity? Remember in the weighted average cost of capital calculation, we came up with the cost of the equity. But before that, we calculated the cost of the equity as a way to come up with a discount rate. Say it. CAPM. What's CAPM? Come on. What is it? Yeah, what's the equation? You need to memorize this. This is what they ask you.
Is it risk-free?
Risk-free
Plus beta.
Plus beta.
Risk of the market minus risk-free.
Return on the market.
Return on the market.
Yeah, you're close enough. Okay, so that's another way of calculating it. Okay, all right. The other way is to discount the dividends. Do a discounted cash flow on the dividends in the future. Divide by the current stock price is going to give you the cost of the equity. So there's like 3 ways of doing it. Okay, but CAPM's number 1 and that's number 2. Thank you. Okay, we got
Sorry. All right.
so I did payback period, so you're gonna have the cost of your initial investment, and you're gonna subtract from that the cash flows until you get to a positive number. So you're gonna take the number of years that it took to get to a positive, so 4, then you're gonna divide, the money still remaining that's negative divided by the next year's cash flows to get a fraction.
Awesome,
4.37.
excellent. It seems a little long.
Yeah.
Usually I would probably reject that. It has to be 3 or under. And for tech stuff, I want it as soon as possible.
All right, so for 1311, we're looking for the weighted average cost of capital for the capital company, which is the company that we're using. And so what we're doing is we're using the debt times the investor required returns. And then once those are multiplied, you're multiplying that by 1 minus the common stock for the company. And then you add in, so you have the preferred stock and then the investor required return. And then you do the common stock and the investor required return for that. And so what we end up getting for the answer here is 9.4% for the weighted average cost of capital. And then for 1316, we're looking for originally the pre-tax cost of debt, and then we go on to find the after-tax cost. And so we start off with the coupon payment over the bond price, which is 75 over 882.35. And so we end up with 0.085. And then when we're going, and so that's the pre-tax cost. And then the after-tax cost, you just do that times 1 minus the common stock, the marginal tax rate. And so then we get 5.1%.
So if you're doing, a little test question here. If you're adding in the tax shield right here, is that going to increase or decrease the cost of capital? If you add in the tax shield, is it going to increase or decrease the cost of capital? If you take into consideration the tax shield on the debt, would it increase or decrease the weighted average cost of capital?
Do you mean if this is increase or
Yeah,
decrease?
if you're going to add the tax shield in there, is it going to increase or decrease the cost of capital?
But
It's going to decrease it. So what does that do to the present value? Net present value. Internal rate of return. Break even. So if you include the tax shield, it's going to make the capital budgets, the capital projects more feasible. Okay. Look at the difference between the cost of capital when you take into consideration the taxes. Pre-tax, after tax. So you had pre-tax, your cost of debt was 8.5%. After tax, it's 5.1. That's almost 300 basis points difference. So this tax shield is a major component to determining the weighted average cost of capital and the feasibility of the projects. In practice, I don't use the tax shield, okay, because I want to use a more conservative WACC. So if I can get the projects to work without the tax shield, I feel really comfortable. Okay. Thank you.
So I have a couple of questions, 9.7 and 9.8, which are very similar. The first one is asking what is the current value of a stock. So using it to provide the rate of return and the dividend. So basically did the simple division, ended up with 27.38, sorry. And similar to 9.7, 9.8, same thing. Dividends divided by the rate of return gives you 40.36.
It's pretty simple.
Yeah.
So my two problems kind of are very similar as well, 12.22 and 12.24. They both involve using the EBIT to get the the break-even point. So basically, they give you that the future future cash flows is $10,200, and you have a marginal tax rate of 30%. And what you do is you take the 10,000, the free cash flows, and subtract the depreciation and amortization costs, which was 3,000, and then you add the capital expenditures to that, which is 2,000, and the working capital, which they also give is 500, and then you take the marginal tax rate of 30% and subtract it by, you subtract that from 1, and then you multiply the two together and you get $13,857.14. And the second problem that I have, it deals with finding they also want how many units the firm must need to generate the EBIT of 20,000. So basically, you add all the EBIT, the depreciation and amortization cost, and the fixed costs, and you get 33,000, and then you subtract that from the flexible. It's basically how much the flexible bows were expected to sell, which was 150, and you subtract that from, I think it's the variable cost, and you get 660 units
As your break even.
as the break-even.
Yeah,
point
that's
in
also
units.
known as the contribution margin. Okay, nice job, Mike.
Alright,
Excellent.
for mine, I did 1324 for the weighted average cost of capital. First, you need to find the total amount of debt, preferred equity, and common equity in order to find the total capital. So the debt was given at 300,000. You calculate the preferred equity at $12 times 2 million is 24 million, and the common equity is $20 times 14 million at 280 million. You add those up to get the total capital of 604 million. And then you use those values to calculate the XDET, XPS, XCS. 300 million over the total capital is 0.4967. The XPS is 24 million over the total capital is 0.0397. The XCS 280 million over 604 million is 0.4636. Then the next step is to find the cost of the capital components. So the capital, or the cost of debt, you plug the values into the formula to get 0.0484. Cost of preferred equity is 0.1. The cost of common equity is 0.16. So then you can use the formula for weighted average cost of capital with these values to find the weighted average cost of capital of 0.0926 or 9.26%.
Thank you. Nice job.
So for this problem, 11.22 is dealing with projects with different lives. So you're trying to choose between the purchasing of one of two machines for a factory, and you're assuming a marginal tax rate of 35% and a discount rate of 50%. So for this solution, since the machines have different purchase costs and different operating lives, you should choose the machine that has the lowest equivalent annual cost. And this is the formula for equivalent annual cost, and you have worked out for machine A and B. So for the answer is you should choose machine B because it has the lowest equivalent annual cost.
Thank you. Which one did you pick? A or B?
B.
B because it was the lowest.
So I did problem
Thanks, Mike.
1319, and that's actually really similar to problem 1316 because we're calculating the after-tax cost of debt. In order to do this, we need to find the yield of maturity first, the yield to maturity first. And so we have our formula, and we are given all of our numbers, so we're plugging in all of our givens into the formula to first find our yield to maturity. And then once we have our yield to maturity, we can use that to multiply by this equation, and that gives us our after-tax cost of debt of 4.62%.
So who's going to present first? Don't all rush up here. this though next Thursday. It's this Thursday. Next Thursday, we're presenting the, huh? Yeah, next Thursday, we're doing the professional presentations on the project. No, on Tuesday, we're doing a lab to finish up the project. What chapter do you have? Mike, did you have one or you?
Our group was chapter 13.
Okay,
That was the last one we were supposed
okay,
to do.
awesome. Did I just go around and ask everybody if you were presenting?
Yes, we did.
Do I have to pull out my notes? Didn't we go over this on Tuesday? Okay, what chapter are you? Okay, which one's that? That's fine, we can do it together. I already have the edited version. Yeah, exactly. Yeah, cool. Okay, so I got 21, who else? Who's got?
Mike will go next.
Okay, cool.
We were
We
18.
can do
Okay. Did you guys go?
No, not yet.
Okay, cool. I have an edited version if you want to use the.
Yeah, we have, I think we also have our own too.
Okay, that's awesome.
You have two?
Okay, so whenever you guys are ready.
Yeah, is there one before 18 that needs to go, or
I'm gonna
no?
go with 18
I don't know. I mean, half the class isn't here, so. Yeah.
We can do
Yeah.
15 today.
Yeah, we,
Okay, cool. Awesome. Whenever you're ready. Yeah, I have, so you have chapter 15?
Yes.
Okay, cool. And then I have 16, team 6.
and they're not here.
Yeah, the whole group's not here.
Yeah, I think so.
Yeah, that's cool. What about 17? 17? Chapter 17? I can't manage this stuff. I'm just gonna go ahead.
The group is probably
So
not
let's
here.
just start with 15, and then whoever's not here, I'm gonna do the presentations. I can't wait around and, I can't, this is, the admin's just ridiculous, so I can't, let's just do it. Okay, we gotta stick with the program. Unless you wanna do all the presentations on Tuesday and eat up in your project time. You wanna do that? No, okay. What's going to happen is you're going to go to work and some people aren't going to show up, and the question is going to be, here, test question. If you have a presentation in front of senior level management, and 2 of the people in your team don't show up, what happens? You do it anyway. It's not your responsibility. Huh? I'm just saying, you're going to be, it's probably rarely going to happen because people will probably get fired. Unless they say. Usually what you do is when you're not going to show up to a meeting, you would notify the person that you're not going to be able to make it and see if they can postpone it. If they can postpone it, that's great. If they can't, then you got to do it anyway. So I would not notify people if you're working with them. Okay? 1, it's just courteous, but 2, it's highly professional. You got to communicate with people. Okay? I guess college is different than the real world, but I really don't see any difference between the 2. And then when you print out the presentation, make sure that only you who presented the presentations sign the presentations, put a signature on it so that I know that you were here to make the presentations. And don't tell the other students that. Because they're going to try to slip it in and say they did. Did they do that? Students do something like that? Never. ready to go, Mike.
Okay, so we have chapter 15, and it's about how firms raise capital. So our learning objectives are, we're gonna explain what bootstrapping is, when raising seed financing and why it's important. We're gonna describe the role of venture capitalists in the economy and talk about basically how they reduce their risk when investing in startup businesses. We're gonna talk about the advantages and disadvantages of going public and computing the net proceeds from an IPO. We're also gonna talk about underwriting new security offerings. Investment bankers prefer that the securities be underpriced to compute the total cost of an IPO. And then there's also discussing the costs of bringing a general cash offer to the market, and talk about basically what public markets do, how they raise money to start up their business. And we're also going to talk about the advantages of borrowing from a commercial bank rather than selling securities in the financial market to discuss bank term loans. So basically, to start, we're going to talk about bootstrapping, and this is basically a process by which many entrepreneurs raise seed money and obtain other resources that are necessary to start their business. The initial money comes from the entrepreneur or other founders. There's also other cash that maybe involved from personal savings, the sale of assets like cars, boats, and personal items, loans from family members and friends, and other loans from credit cards. This money is spent in making typically the prototype, and it usually lasts for about 1 to 2 years. The venture capital industry involves venture capitalists. These are individuals or firms who basically help new businesses get started and provide the early financing. The individual venture capitalists are often called angel investors. They're like angel investors, and these are just wealthy individuals who invest their money in startup companies and just early up and coming businesses to get them started. This kind of started in the 1960s with the formation of the first venture capitalist limited partnerships, and this has basically really grown in the current age and has really shown to be very popular, especially with the high technology investments, because they're seeing a lot of return on that. The venture capitalist funding cycle is basically, it has many steps. Start a business plan, and that basically describes what the business is and what you're going to do. There's the first stage in financing, which basically is meetings with the management team and the other venture capitalists. They basically will look into the project and see if they like it and talk about numbers. Then another step is reducing the risk, and this is basically how venture capitalists know that only a few companies are actually successful in the startups, which is often what they invest in. And there are tactics like in funding the ventures in stages, and that require entrepreneurs to make personal investments, syndicating investments, and basically seeing if they have enough knowledge in the industry to really be successful in products that they're specializing in. Venture capitalists, they also do a lot more than financing. It depends on the experience, obviously, but they do provide a lot of advice, because typically, if they're going to be financing a project, they typically have industry knowledge and general knowledge for what it takes to succeed. So they also provide counsel counsel, and often they'll send businesses in like the right direction if they see they're struggling in a certain stage of their operation. There's the venture capital cost, which is the cost of venture capital funding. The cost is usually very high, but the high rates of return are earned by venture capitalists are typically not unreasonable. Typical venture capital fund may generate annual returns of about 15 to 25%, compared to the average annual return of the S&P 500 of about 12%. The IPO, or initial public offering, is a way that to raise larger sums of cash or to facilitate the exit of a venture capitalist is through basically the company going public, and this is basically where first time stock issues are given a special name, because the marketing and pricing of these issues are just different from the seasoned offerings, and basically this is where the company's stock becomes common stock. There are many advantages to going public. Typically, this means like companies really getting big at this point, and the amount of equity that can be raised in public equity is way larger than if it's if it's in the private sector. Once a company goes IPO, additional equity capital can be raised through follow-on seasoned public offerings at a lower cost, and it can also enable an entrepreneur to fund a growing business without giving up control, as long as, I think it's like, if they have majority ownership. After the IPO, there is an active secondary market where stockholders can buy and sell its shares. Publicly traded firms typically get better management, attract more management talent than the smaller in the private sector, and there's probably more motivation for the managers because it is publicly traded stock, and it's basically in a bigger market. There are also disadvantages of going public. IPO is typically very costly and expensive, and there are costs with the ongoing SEC disclosure requirements that kind of are also a disadvantage. And there's a kind of a transparency that comes from the SEC compliances that can be very expensive for some firms, and there's also many investors will say that the SEC's requirement of quarterly earnings forecasts and quarterly financial statements kind of encourage managers to focus on short-term profits rather than looking long-term in the future. And there's also basically what IPO does. There's investment banking services which are required to complete an IPO. These are basically where experts in banking are bringing like new securities to the market, and investment bankers provide about three basic services when bringing securities to the market, which are origination, underwriting, and distribution. And the investment banking firm will manage the IPO process is important because it deals with the management of the firm, and not all investment banks are equal, so it kind of is very specific to that firm. And securing the services of an investment banking firm with a reputation for quality and honesty just kind of help improve the market's receptivity and help ensure that the IPO is successful, or at least try to.
Alright, so continuing with the initial public offering, there's also underwriting. And so underwriting is the risk-bearing part of investment banking. Securities can be underwritten in two ways. One, on a firm commitment basis, second, on a best effort basis. So IPO pricing and cost. So the underpricing debate, the issuer prefers the stock price to be as high as realistically possible, while the underwriters prefer the same degree of underpricing. In a firm commitment offering, the underwriters will suffer a financial loss if the offer price is set too high. Under a best effort agreement, the issuing firm will actually lose this. So there are three basic costs associated with issuing stock in an IPO. The first one, underwriting spread. That's the difference between the proceeds the issuer receives and the total amount raised in the offering. The second, out-of-pocket expenses, other investment banking fees, legal fees, accounting expenses, printing costs, travel expenses, SEC, filing fees, consulting fees, and taxes. And lastly, underpricing, that's defined as the differences between the offering price and the closing price at the end of the first day of IPO. So, general cash offer by the public company. So, if a public firm has a high credit rating, the lowest cost source of external funds is often a general cash offer, also referred to as a registered public offering. Similarities between procedures between general cash offer and those involved in an IPO. So there's several over here. Management decides type of security and amount raised. Approval is obtained from the board of directors to issue securities. The issuer files a registration statement and satisfies all the security laws enforced by the SEC. At the closing of a firm commitment offering, the issuer delivers the securities to the underwriter, and the underwriter pays for them, net of its fees. So there's comparative versus negotiated sale. In a general cash offer, management must decide whether to sell the securities on a competitive or negotiated basis. So first, in a competitive sale, the firm specifies the type of amount of securities it wants to sell and hires an investment banking firm to do the origination of work. In a negotiated sale, the issuer selects the underwriter at the beginning of the origination process. Okay, so the lowest cost method of sale. So we talked about competitive and negotiated with results in the lowest possible. Then we have competitive bidding, which keeps everyone honest. The greater number of bidders, the greater the competition for the security issue, and lower the cost to the issuer. And in selecting the best method for debt issues, most experts believe that competitive sales are the least costly. For equity securities, negotiated sales provide the lowest cost method. So we have also private versus public markets. So because smaller firms and firms of low credit standing have limited or no access to public markets, the cheapest source of external funding is often the private markets. Bootstrapping, as Mike already mentioned, and venture capital investment financing are part of the private market as well. And choice of markets is a function of two things: the desire to avoid regulatory costs and transparency requirements, and preference for working with a small group of sophisticated investors rather than the public at large. So we have private placements. This occurs when a firm sells unregistered securities directly to investors, such as insurance companies, commercial banks, or wealthy.
Hit on some of the highlights instead of reading, because we're running out of time.
Yeah. Okay. Let's for that one. Also continued. Equity firms. So private equity firms, the manager is looking to increase the value of firms they acquire by monitoring the performance and providing better management. Same thing. Private investments in public equity, basically transactions in private investments in public equity, in which a company sells unregistered stock to an investor, often a hedge fund or some other institutional investor. Commercial banking lending, you have prime rate loans and bank term loans. And that is it.
Great, thank you. You need to write this down. You need to take these notes. And then you can come up and set up for the next presentation. When you do an initial public offering, in most cases, the investment banker is going to underprice the share by 20%. So not only do they make the investment banking fee, but they also make an arbitrage on underwriting the security. So maybe they'll get, 5 or 10% on the issue, but they'll get another 20% from the pot. Usually the investment banks, if it's a really good issue, they will do a firm commitment and they will take out the whole issue. Uber's going to have a selling team. There's probably half a dozen investment banks that are involved in it because it's going to be so popular and such a big issue. Some of the investors who had invested originally in Uber will make billions of dollars on that once it goes IPO. Billions in the IPO. The investment banks will probably make 20% plus. They'll all probably be doing firm commitments, taking out the issue, and then reselling it at least at a 20% premium from which they bought it at. Usually when companies are taken out, bought out over a period of time, I don't know what it is, it's the magic 20%. Usually when companies get bought out by another company, they're going to bid up the acquisition price about 20% over the current stock price. 20%, 20%, 10% per year in appreciation of the stock. So if you buy really well in stocks, you can make a lot of money, if you know how to pick them. Okay. And I've worked with multiple companies that have tried to go startup. Usually you're going to start with family and friends money, founders money. You're going to bootstrap it for as long as you can. If you can get the company to generate revenue, if you can get it to generate revenue, then the venture capitalists will come in, slap a multiple on that revenue, and then ramp it up, and then what they'll do is they'll fund you. Usually the amount of funding is between $25 and $50 million on funding. Usually, if you're lucky, you'll get $5 million up front, but usually they want to put more in, between 25 and 50, and as you know, once the company is ready to go public, 4 to 5 years down the road, there could be a lot of money that's actually made. That's why a lot of people are focusing on startup companies. They want to work with startup companies because they know that the majority of the wealth that they're going to make is going to be when the company goes public or when the company gets taken out by another large publicly traded company, where they will give you cash and they will also give you exchange for stock in their company. That's how I made a bunch of money, was working for public companies. So, that's what I would be focusing on. All right, so who's got chapter 16?
That's me.
Okay, excellent. And did you edit it down?
Yeah.
Okay, cool, thank you.
so chapter 16 is capital structure policy. Capital structure and firm value. A firm's capital structure is the mix of financial securities used to finance its activities. The mix will always include common stock and will often include debt and preferred stock. The debt at a firm can be long-term or short-term, secured or unsecured, convertible or not convertible into common stock, and so on. And the fraction of the total financing that is represented by debt is a measure of the financial leverage in the firm's capital structure. So optimal capital structure, managers at a firm choose a capital structure so that the mix of securities making up the capital structure minimizes the cost of financing the firm's activities and therefore maximizes the total value of those projects. The Modigliani and Miller propositions, or M&M, Proposition 1 states that the capital structure decisions a firm makes will have no effect on the value of the firm if there are no taxes, no information or transaction costs, and the real investment policy of the firm is not affected by its capital structure decisions. The business risk associated with the characteristics of the firm's business activities. Financial risk is associated with capital structure of the firm, which reflects the effect that the firm's financing decisions have on the riskiness of the cash flows that the stockholders will receive, and it's associated with required payments to firm lenders. The M&M propositions tell us exactly where we should look if we want to understand how capital structure affects firm value and the cost of equity. Venture capital. So venture capitalists provide more than just financing. The extent of venture capitalist involvement depends on the experience of the management team. One of the most important roles is to provide advice. Because of their industry and general knowledge about what it takes for a business to succeed, they provide counsel for entrepreneurs when a business gets started and during their early stages. So the benefit of debt, interest tax shield benefit. The most important benefit from including debt in a firm's capital structure stems from the fact that firms can deduct interest payments for tax purposes, but cannot deduct dividend payments. This makes it less costly to distribute cash to security holders through interest payments than it is through dividends. The total dollar amount of interest paid each year, and therefore the amount that will be deducted from the firm's taxable outcome, is T times K debt. This will result in a reduction in taxes, where T is the firm's marginal tax rate that applies to the interest expense deduction. If this reduction continues in perpetuity, the present value of the tax savings from debt is the tax savings debt equals PVA, which is, that formula right there. The perpetuity model assumes that the firm will continue to be in business forever. The firm will be able to realize the tax savings in the years in which the interest payments are made, and the firm's tax rate will remain constant. With the taxes, the cost of equity can be written as KCS equals K assets plus B debt, BCS times K assets minus K debt, 1 minus T. Other benefits, underwriting spreads, and out-of-pocket costs are more than 3 times as large for stock sales as they are for bond sales. And debt provides managers with incentives to focus on maximizing cash flows that the firm produces, since interest and principal payments must be paid when they are due. Cost of debt. Financial managers limit the amount of debt in their firm's capital structures, in part because there are costs that can become quite substantial at high levels of debt. And at low levels of debt, the benefits are greater than the costs, and adding additional debt increases the overall value of the firm. At some point, the costs begin to exceed the benefits, though, and adding more debt financing destroys firm value. Financial managers want to add debt just to the point at which the value of the firm is maximized. bankruptcy costs, also referred to costs of financial distress, are costs associated with financial difficulties that a firm might get into because it uses too much debt financing. Bankruptcy cost is used rather loosely in capital structure discussions to refer to costs incurred when a firm gets into financial distress. Firms can incur bankruptcy costs even if they never actually file for bankruptcy. Direct bankruptcy costs are out-of-pocket costs that a firm incurs as a result of financial distress. Indirect bankruptcy costs are costs associated with changes in the behavior of people who deal with the firm in financial distress. Agency costs result from conflicts of interest between principals and agents, where one party, the principal, delegates its decision-making authority to another party, the agent. The agent is expected to act in the interest of the principal, but agents sometimes have interests that conflict with those of the principal. Stockholder manager agency costs occur to the extent that if the incentives of the managers are not perfectly identical to those of the stockholders, managers will make some decisions that benefit themselves at the expense of the stockholders. Using debt financing provides managers with incentives to focus on maximizing the cash flows that the firm produces and limits the ability of bad managers to waste the stockholders' money on negative NPV projects. These benefits amount to reductions in the agency costs associated with the principal-agent relationship between stockholders and managers. While the use of debt financing can reduce agency costs, it can also increase these costs by altering the behavior of managers who have a high proportion of their wealth riding on the success of the firm through their stock holdings, future income, and reputations. The trade-off theory. The trade-off theory of capital structure says that managers choose a specific target capital structure based on the trade-off between the benefits and the cost of debt. The theory says that managers will increase debt to the point at which costs and benefits of adding an additional dollar of debt are exactly equal, because this is the capital structure that maximizes firm value. The pecking order theory, this recognizes that different types of capital have different costs. This leads to a pecking order in the financial choices that managers make. Managers choose the least expensive capital first, then move to increasingly costly capital when the lower cost sources of capital are no longer available. Managers view internally generated funds or cash on hand as the cheapest source of capital. Debt is more costly to obtain than internally generated funds, but still relatively inexpensive. Raising money by selling stock is the most expensive. Empirical evidence. When researchers compare the capital structures in different industries, they find evidence that supports the trade-off theory. Some researchers argue that, on average, debt levels appear to be lower than the trade-off theory suggests they should be. More general evidence also indicates that the more profitable a firm is, the less debt it tends to have, which is exactly opposite what the trade-off theory suggests we should see. This evidence is consistent with the pecking order theory. The pecking order theory is also supported by the fact that in an average year, public firms actually repurchase more shares than they sell. Both the trade-off theory and the pecking order theory offer some insights into how managers choose the capital structures for their firms, but neither is able to explain all of the capital structure choices that we observe. I think that's it.
Thank you. Okay, there was a couple slides in here that I wanted to go over with you really quickly. This was one of them. Right here. So as the leverage ratios go up, the debt to, you wanna watch this. As the debt to equity ratios, as more leverage is applied to the firm, at some point in time, the cost of capital increases along with the leverage ratios. Okay? Even though you get the tax shield associated with the interest on the debt, which motivates you to issue more debt than equity, which makes that equity more costly than debt. So there's an incentive, right, to issue more debt than there is equity. But it's not linear, it's actually, it's convex, actually. And this is really this is the major takeaway right here. Just my luck. Oh, okay, here. So this is the value of the firm, this is the leverage ratios. You could be using debt to equity or you could use debt to total market cap, okay? Which is that piece, you know, in the weighted average cost of capital when you divide the value of the debt, divided by the value of the debt plus the equity. That's the total market cap, or debt to equity. So here's the value of the firm, here's the debt to equity or the leverage ratio. So as you can see, as you take on more debt, the value of the firm goes up. You're leveraging up the equity in the firm, okay? The reason why you're using more debt and increasing the value of the firm is because you're leveraging up the equity within the firm by using debt, using somebody else's money. So you can lever up the value of the firm even though it violates some of the Modigliani-Miller hypotheses. But the problem is right here. At some point in time, firms are incentivized to use debt. If they use too much debt, all of a sudden the marketplace looks at them and says there's bankruptcy risk, there's default risk on the bonds and bankruptcy risk for the company. Because what happens when you go into a recession and your earnings go down and you have all this debt and you gotta make those debt payments? If you don't have enough money to pay off the bondholders, the bonds are gonna go into default. If the bonds go into default and stay in default, the bondholders are gonna sue the company and force it into foreclosure to liquidate the assets to get paid back. That's the worst case scenario. So at some point in time, if you're increasing your debt to equity or you're increasing your leverage past the optimal point, the cost of the debt and the equity starts to go up in an exponential fashion and starts to destroy the value of the firm. So we're watching that. The equity holders are watching it and the debt holders are watching it. And the first thing they're going to ask is, can the company continue to grow earnings at a constant rate in the future? And two, can they continue to pay off the debt? And are they over leveraged? And if they're over leveraged, I'm going to sell the stock and I'm going to sell the bonds, and that's going to cause the cost of the debt and the equity to go up. Okay? So the CFO is looking at the capital structure of the firm constantly to minimize the weighted average cost of capital, but also maximize the value of the firm by managing the liability side of the balance sheet. Okay? That was the major takeaway from that part. What's not in your book, it's not in your book because we don't offer an intermediate financial management class here at St. Mary's. We don't offer that. But if you went, and the book doesn't talk about this either, which is pretty surprising, is CFOs and CEOs and COOs focus, particularly in publicly traded companies, on what is called economic value add, or EVA. Okay, it's extremely important that you understand this. And if you listen to the analyst conference calls when every quarter when the publicly traded firms are having quarterly updates to the analysts and the institutional investors, they're going to talk about EVA. Okay? And I'm going to put EVA up on here, which is in a very simplistic form, but it needs to be communicated. So you're going to take the value of the assets. Now you could use either book or market for the value of the assets. Then you're gonna multiply it by the internal rate of return of the company. And this is obviously a percentage right here. So this is blended. It's gonna be your blended. This could be nominal or risk adjusted. Internal rate of return on the assets within the company. And you're gonna get some kind of dollar amount here. Some dollar amount internal rate of return. And then over here, you're gonna have the dollar amount of liabilities multiplied by the weighted average cost of capital, obviously in a percent. And you're gonna get a dollar amount of the weighted average cost of capital and liabilities. And you're gonna subtract them out. And the result is economic value added, or EVA. So this is what you're looking for. This is what the CFOs, CEOs, COOs are looking at. Is this increasing over time? And is it positive? Because if it's negative, then the cost of your liabilities are greater than your dollar return on your assets, which means this is going to be negative, which means you're going to go bankrupt. And people are going to sell your stock. Okay. If you use book value, of the assets and the liability, it's called economic value add. If you're using the market value, it's called MVA, market value add. And then the last piece is this piece right here. The internal rate of return. The internal rate of return minus the WACC. Which equals the spread. This is what companies focus on. And the spread's got to be positive. If it's positive, you're going to get stock price appreciation. So if you can maximize the internal rate of return on your assets well over your weighted average cost of capital, you're going to have a positive spread. It's going to maximize the value of the company. If it's negative, you're destroying value. And they're going to dump your shares, dump your stock, dump your bonds. Your cost of capital is going to go through the roof, and you're pretty much going out of business. You'll be a takeover target if you have a brand and if you have any assets. Usually from what I've seen is the spreads on these for established companies are about 150 basis points. What's 150 basis points on a percentage basis? 1.5%. That's what I've seen. And then large mutual insurance companies that are ultra conservatively leveraged, they can actually get away with 100 basis points or 1% forever and maximize the value of the company. And then obviously tech companies and small cap companies, the spread's got to be larger because of the risk associated with the entity. Okay, so that's your mini intermediate financial management right there. Okay, so who had chapter 17?
No, they're not here.
Not here. Okay, let me do it. So you can get through this. Oh, this is dividend policy. I'm going to burn through this pretty quickly. There are different types of dividends. Usually when you get paid a dividend, you get paid a cash dividend. Okay? Now, dividends are extremely important for established companies, because usually what happens is established companies will generate so much cash, so much earnings, that they retain the earnings as the cheapest source of capital instead of going and raising capital in the stock and the bond market. they'll retain their earnings and use that as organic sources to fund working capital within the firm. But the problem is that at some point in time you have too much cash. You can't retain it all. So you gotta pay it out as a cash dividend to your shareholders. And by doing that, you're returning and rewarding the existing shareholders for buying your stock in the first place, and you're returning their capital to them in the form of a cash dividend. The key in dividend policy is you can never, ever stop paying a dividend once you've paid the dividend. If you stop paying the dividend, the stock price is going to correct significantly. And the investors are not only expecting a dividend every quarter, but they are expecting the dividend to grow at a constant rate forever, over time. So if you can provide a dividend and you can grow it at a constant rate over time, you're going to maximize the value of the firm. So dividends are extremely important. I love dividends. I love dividend yields. I love to buy stocks that give me 3 to 5% stock price appreciation every year and provide me with another 3 to 5% in dividend yield on an annual basis. I'm also receiving those cash dividends every quarter, so they're going into my pocket and I can use them for whatever I want. I gotta pay income taxes on the dividends that are paid out. But again, I'm getting money stuffed in my pocket every quarter, and not a promise that I'll get paid a dividend in the future, or a promise that the stock price will go up in the future. You can also get paid dividends in shares. So maybe you're returned, maybe you bought 100 shares and they're going to give you 10 shares, as a stock dividend to you. Yes.
Do you still pay taxes on that when you get that stock dividend, or do
No.
you pay that when you pull it out?
You pay when you pull it out, okay? Because you're getting the stock.
Yeah.
Right. So then you don't pay taxes on it. That's one of the beauties of investing in non-dividend paying stocks, is that basically it's tax deferred. So you buy the stock, it appreciates, you don't pay any taxes on it until you sell the stock and you pay the capital gains. Okay. There are also stock splits. There's reverse stock splits, and then there's stock splits. Stock splits are pretty straightforward. I got a 100 share, I got two shares in the stock. I got, they're $100 each per share, so $200, 2 shares. All of a sudden, they do a stock split. So now I have 4 shares at $50. Nothing happened. There was no creation of wealth to you within a stock split. So the question is, why do companies split their stock? Well, Apple did it a couple times. Their stock went from $50 to $100, and they did a stock split and brought it back down to $50. Investors, smaller investors, are more inclined to purchase stocks around $25 to $50 as opposed to $100 to $200. So by doing a stock split, it doesn't change your wealth, but it does increase the number of shares that you own, but also lowers the actual share price to make it more appealing to smaller investors. And it creates liquidity and market depth because there's more shares in the marketplace. The last dividend is a special dividend. It could be a return of capital. Maybe you sold off a division of the company or equipment or assets. You have all this cash sitting around. You can pay a special stock dividend that way. That's all I'm going to talk about in regards to dividends. Who's doing chapter 18? Okay, awesome.
We got like less than 5 minutes.
In the class?
Yeah,
Okay. Well, can you do it in 5 minutes?
we can try to.
Okay, cool. Why don't you just present from there?
Okay.
Just give us a high-level overview. And this is chapter 18?
Yeah.
Okay. Maybe we should do the rest of them on Tuesday.
Yeah, we can do it in like 5 minutes on Tuesday.
Yeah, let's finish them on Tuesday, and then we'll make the other people that didn't show up, make new problems. And then you guys can work on your projects.
Okay, cool.
All right, perfect. And then if you want me to look at anything,